All right, let's jump right into this explainer. We hear nonstop about the AI hype, right? The chatbots, the flashy software. But here's the fundamental truth we've got to acknowledge. AI is just ridiculously expensive, like seriously expensive. So today we're doing something a little different. We are following the money. We're going to trace the actual cold, hard cash flowing directly from the biggest tech giants straight into the physical hardware that makes all this artificial intelligence actually work. We'll map out the whole infrastructure layer and find out exactly who is cashing these massive checks.
Now, this brings us to the burning question on literally everyone's mind. Is this whole AI market just a giant bubble? I mean, we're seeing data centers the size of small cities popping up, right? They're even restarting retired power plants just to feed these incredibly hungry machines. And the silicon inside them, it costs more per wafer than a lot of houses. So to really figure out if we're looking at a massive structural shift or just a speculative bubble, we need to start by wrapping our heads around the sheer, mind-bending scale of the spending.
Just look at this number, $725 billion. That staggering figure is the estimated capital expenditure that the biggest hyperscalers, we're talking Microsoft, Amazon, Alphabet, Meta, are pouring into AI infrastructure in the year 2026 alone. Think about that. These aren't some risky speculative startups. These are literally the most cash-rich companies on the planet. And crazy enough, that number just keeps getting revised upwards. This isn't just code and software development. We're talking concrete, steel, thousands of miles of fiber optics, and millions of physical processors being deployed out there in the real world.
To make sense of all this, here's our roadmap for the explainer today. 1. The big AI spend. 2. Who actually gets paid. 3. The trillion-dollar future. 4. Are valuations fair? 5. Rising shareholder returns. And 6. Risks and core takeaways.
All right, let's dive right into part 1, the big AI spend.
The absolute scale of the spending is just breathtaking. You've got Amazon guiding toward a whopping $220 billion in CapEx. Alphabet is right behind them at around $200 billion, and Microsoft is tracking near $190 billion. But here is the absolutely crucial thing you have to understand. This money doesn't just sit internal as pure profit for these hyperscalers. To build these massive AI clusters, this cash has to flow outward. It leaves their balance sheets to pay for the actual physical infrastructure needed to make AI function at this insane scale.
Which brings us perfectly to our second section. Who actually gets paid?
Sitting right smack in the middle of this massive wealth transfer is, you guessed it, NVIDIA. They are holding down a staggering 80 to 90% monopoly on the AI accelerator market. Because they design the dominant GPUs and the full-stack systems used for training and running these colossal AI models, every time those hyperscalers spend their billions, NVIDIA effectively gets to act as the primary toll collector for the entire industry.
And boy, does that market dominance translate into some mind-boggling financials. For the fiscal year ending in January 2026, NVIDIA is looking at a record revenue estimate of roughly $216 billion. That's up 65% year over year. To really put that magnitude into perspective, they're capturing roughly $30 to $35 billion out of every $50 billion the hyperscalers spend on infrastructure. I mean, that is literally the dictionary definition of getting paid.
But hey, the wealth definitely does not stop at the GPU. It naturally flows all the way down the physical infrastructure stack. You've got compute chips tying into custom silicon, high bandwidth memory, and some seriously advanced thermal solutions. For instance, AMD is stepping up as a very credible second source for that processing power. Then you have Broadcom, who handles the critical networking switches that physically connect thousands of GPUs so they can actually talk to each other. Micron is providing the specialized memory that sits right next to the processors. And going even further down the line, companies like Vertiv and Eaton are locking in massive prolonged orders. Why? Because these modern data centers run so incredibly hot that they demand entirely new architectures for power management and liquid cooling. It's a whole ecosystem.
So, is this just a flash in the pan? Let's talk about part 3, the trillion-dollar future.
$2 trillion. That massive figure right there represents the combined remaining performance obligations for the major cloud providers. Or in plain English, that's contracted future revenue. This backlog is up over 180% year over year. Honestly, a backlog jumping by that kind of magnitude is an absolute unicorn event in traditional hardware markets. What it does is give suppliers this incredible multi-year runway to fulfill massive hardware orders without constantly looking over their shoulders, wondering if the demand is just going to dry up next quarter.
Just listen to this recent disclosure straight from NVIDIA. They reported a confirmed order pipeline approaching $1 trillion through 2027 from the world's largest technology customers.
That kind of unprecedented, multi-year visibility, it completely proves that the smart money is betting big on sustained growth well into the early 2030s. The major players aren't just buying chips for whatever today's popular chatbot is, they are laying down the heavy industrial tracks for the next entire decade of global computing.
Now this leads us to part 4. Are valuations fair? Look, premium valuations are absolutely to be expected when you're dealing with high-growth compounders. But if we dig into the math here, it reveals something really fascinating. While NVIDIA's trailing PE is hovering around 33 to 34 times, the forward PE for fiscal 2027 actually drops down to between 22 and 25 times. So, what does that mean? Well, the valuation multiple has actually compressed. The stock has arguably gotten cheaper relative to its earnings power simply because the absolute earnings estimates have skyrocketed to meet the insane demand.
So on the surface, sure, a stock might look incredibly expensive. But when we compare that high trailing PE to the PEG ratio, which actually factors in all that massive future growth, we see a highly favorable PEG ratio of 0.4 to 0.7. That is well below 1.0. Historically, that signals the incredible future growth we just talked about is not even fully priced into the stock yet. It's kind of the exact opposite of classic bubble behavior, where you see prices soaring uncontrollably without any actual underlying earnings to back them up.
Moving on to part 5, rising shareholder returns.
25 times. And a pretty massive flex of financial strength, NVIDIA recently hiked its quarterly cash dividend 25-fold. And on top of that, they authorized a staggering $80 billion share repurchase program. Now, historically, semiconductor growth companies would hoard every single penny of their cash just to aggressively reinvest. But today, they're generating so much free cash flow that they can heavily invest in the future while simultaneously dumping billions and billions of dollars right back to their shareholders.
And you know what? This shift isn't just isolated to one company. We are seeing a massive evolution across the board. Microsoft just continues to deliver double-digit dividend growth. Broadcom is offering yields higher than most pure growth names in the entire market. And across all the supporting infrastructure peers, we are seeing rapidly expanding buybacks. What this means for us is that right now, incredibly low payout ratios leave a massive runway for both dividends and buybacks to keep expanding as free cash flow scales up.
All right, let's wrap this up with part 6, risks and core takeaways.
Because let's be real, no investment is without risk, and we need to look at the complete, unvarnished picture here. First up, hyperscalers are actively developing their own custom silicon to try and compete with standard GPUs and bring their costs down. Second, we've got those ongoing, completely unpredictable geopolitical tensions surrounding advanced semiconductor manufacturing. Third, there are hard, unyielding physical limits to deal with, specifically power availability and really strict local permitting for building new data centers. And finally, if the end users out there don't see a solid return on investment from actually using AI applications, this massive hardware spending could eventually hit a brick wall. This reality is exactly why diversification across the entire physical stack, from the chips all the way down to the cooling and power, is just so critical. Ultimately, the core takeaway from our explainer today is crystal clear. We are in the absolute thick of the AI infrastructure supercycle. AI is unimaginably expensive to build, sure, but the companies designing, manufacturing, and selling the actual physical ingredients, they are the ones cashing the massive checks today. And based on those trillion-dollar contract backlogs we looked at, they're going to be cashing them for the foreseeable future.
So the AI gold rush is happening, but the real wealth is being made by the companies selling the digital picks and shovels. The question I want to leave you with is this: which layer of this trillion-dollar infrastructure stack are you keeping your eye on the most? Let me know your thoughts down in the comments. Thank you so much for joining me for this explainer. Always remember to do your own due diligence, and I'll see you in the next one.